Good morning. We are half an hour from the opening bell. Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm David Ingles with Stephen Engle.
Our top stories today. Asian stocks rise following a volatile session on Wall Street as investors weigh renewed trade tensions between China and the U.S.
Yep, we're looking at mixed messages, in fact, just on that very note here from the White House as President Trump declares a trade war with China. Well, Treasury Secretary Scott Bessent suggests a longer pause on higher tariffs.
And Chinese state media calling for resilience in fighting what it calls a protracted war. We speak to an advisor to China's Ministry of Foreign Affairs for more insight into Beijing's thinking.
And TSMC demand outlook is going to be very much in focus as the company releases earnings today as investors gauge whether the AI-fueled stock rally has further to go. A very good Thursday morning to all of you from the Asia Pacific. Thank you for joining us. Lots to get through this hour. First and foremost is we're coming off a fairly bouncy session on Wall Street. U.S. futures are flat. We are on the higher side of what would have been really a range-bound trade. So largely, the Kospi index is doing a lot of the heavy lifting right now. TSMC is coming online. We're looking at a flat open of about $5 there. It's certainly the 3% pop in ADRs overnight. You do the difference there. That's a 20-plus year high on the premium between the two. Well, we'll preview earnings in a moment here. Flip the page, please. The story across currency markets, certainly broadly, was from this time yesterday, was that very strong fix out of the PBOC. We'll watch, obviously, what happens today and what that fix looks like. The reason I bring that up this early was, in some ways, that actually triggered the weakness that we basically saw throughout the session on Wednesday on the U.S. dollar. Hence, we're trading at about these levels on your screens. I mean, all that being said, intervention watch, we know that story, of course, how that played out as far as the Indian markets go. More on that as well coming through later on. Right, as far as the, currency markets is really part and parcel the debasement trade. Is that a good way to describe what's taking place here? Gold, as you can see, is powered completely through and cut through that 4,200 like a knife through butter to the upside. Silver futures also seeing some decent upside right now. What is interesting, though, is Bitcoin trading at about the low end of the 3-month range. We've been flirting with, let's call it 110,000 just for a nice whole round number as far as that's concerned. So we'll see what happens with this one. Going into the open today, last we checked, we were trading slightly on the weaker side of futures, and that's still what we're seeing going into the session today. 185 right now, dollar honky bottom of your screens, and lots to get through as far as the agenda for today. Just to also mention that we did get the credit numbers for September, which were, I think, wanting when you look at some of the components there, Steve.
Yeah, that's right. Obviously, some bond issuances were a little bit down continually 2 months in a row, but again, households and corporates are not borrowing as much. All right, let's look at the agenda. Obviously, U.S. trade, China trade tensions are going to be throughout the morning, so I won't dive into that right now. The stock market, also going to be a persistent theme today. Earnings, Fuyao Glass, they make automobile windshields and the like. So trade tensions, how will they be impacting their earnings? China Tower, they also build those large telecommunication towers. We'll have to see how, a slowdown in 5G spending affects China Tower. Beijing Yunji, that's going to be a IPO today in Hong Kong. They make humanoid robots, so embodied AI. And then,
who doesn't these days?
Yeah, who doesn't these days? There's a lot of them, right? And some of these stocks, these are interesting. Zhejiang Sanhua is in focus, talking about robotics. They make robotic parts, and there was rumors on the market and reports that Tesla had made a big order. Sanhua coming out and saying they're denying that right now. So again, they had a pop-up. We'll have to see how they respond today. And PCCW, this is an interesting story. The FCC in the United States is essentially taking steps to block PCCW and its units. It's a Hong Kong telecom company, a dominant player here, from using U.S. networks on national security concerns. They're asking PCCW to explain why they should stay live in the United States. It follows what happened to China Telecom and China Unicom a few years ago as well. So lots to go through. ANTA is another one. They're trying to limit the damage to this fireworks display in Tibet, which caused environmental concerns among locals because of its unit, Arcturus.
Yeah, I think the report there was to your point, right? They've been asked to compensate, I believe, believe, for the fireworks, literal fireworks issue there in Xizang. Okay, let's have a look at to Steve's point, right? Geopolitics very much in focus, the trade tensions here. And Donald Trump, the U.S. president, was actually asked about the trade war and whether or not the U.S. was in fact in one. Here's how he actually framed and phrased that specific answer.
Are we in for a sustained trade war with China?
Well, you're in one now. Look, we have 100% tariff. If we didn't have tariffs, we would be exposed as being a nothing. We would have no defense.
President Trump spoke after Treasury Secretary Scott Bessent floated a longer pause on high U.S. levies targeting China to resolve a conflict over critical minerals.
Right now, we are currently in a 90-day roll on the tariffs. So is it possible that we could go to a longer roll in return for a delay? Perhaps, but all that's going to be negotiated in the coming weeks.
Now, for the view from Beijing, here's a quick glance at today's edition of the People's Daily. An article on Xi Jinping's economic thought strikes an assertive tone on trade tensions with the United States. It frames the tariff spat as among the, quote, tough battles and protracted wars China must endure to make the economy stronger. It says China will fight to the end and, quote, Xi's call for party members to, quote, enhance the sense of crisis, carry forward the spirit of struggle, and improve the ability to fight.
Yeah, looks like both sides are geared up for something a bit longer than maybe most had expected this time last week. Derek Wallbank is with us, our Bloomberg senior editor, joining us to help us understand really the setup, Derek, as we go into, well, hopefully the meeting still in 2 weeks' time, Derek. So, I mean, stakes are obviously quite high, but both sides seem to be digging in more than expected here.
Yeah, that's exactly right, David. I would read this in a couple of different ways. I don't read this as Donald Trump necessarily declaring that there is a trade war as like a fresh new declaration. What I do read this as is Donald Trump sort of surveying the landscape of where we are and noting that there are, trade conflicts between the United States and China. It's more of an observation than a declaration, if that makes sense. But certainly, look, you're exactly right. The U.S. and China have been ratcheting up trade tensions incrementally in the lead up to this widely expected Trump-Xi meeting that could happen within weeks on the sidelines of the APEC conference in South Korea. You have seen China not be importing U.S. soybeans. Remember, we talked the other day about the idea that that is not just a commodity, but that's also a shot at Donald Trump's political supporters. Then you're talking about Trump having his own, retaliation, and looming over this is a threat of 100 percentage point increase in U.S. tariffs on all imported Chinese goods.
Hey, Derek, you mentioned APEC. There's another gathering, obviously, in D.C. IMF, World Bank, and G7 finance ministers will be there. They're mulling how strongly worded statement, if at all, essentially their response to China's actions to curb rare earth mineral exports. What do you think will come of that?
Well, Stephen, yeah, I'm waiting to see exactly what they say here, if this is going to be strong words or if there's going to be actions attached to them. I mean, look, the idea of Beijing effectively controlling supply lines for critical technologies is something that G7 officials are certainly concerned about. We have heard that concern from a number of them, but what reaction they're going to take is a little bit difficult. I mean, you're talking about a lot of economies independently. We've already seen the European Union, talk about some, tougher stances towards China in terms of some of this technology. But we've also seen a lot of tough rhetoric fail to get backed up by actual policies that are especially that are coordinated across economies. That it adds in a range of difficulty.
All right, Bloomberg senior editor Derek Wallbank in San Francisco. Well, there's more on the U.S.-China spat coming up. The director of Fudan University's American Studies Center joins us to chart the course forward. That possible Trump-Xi meeting later this month.
Yeah, the segue really from the rare earth story is really, in fact, quite a natural one, right? It's rare earths for chips, and it takes us nicely into the TSMC story, where global investors, when you look at just this absolute surge we're continuing to see in the U.S. session here on TSMC, ADRs are, we're up 3%. I think we're up we're actually flat right now on a Taiwan listing, juxtaposing those two things. And what you have effectively now is the premium, which usually does trade at a premium, just to note that as well, is now more than at a 2-decade high as far as the valuation is concerned here. And yeah, it certainly now begs the question, ahead of earnings, is there anything TSMC can actually say and guide towards in as far as bolstering even further this entire ecosystem of semiconductors that's rallied quite substantially? I think you had HSBC and NVIDIA story overnight. Let's get into this, right? The quarterly results are due in a couple of hours here. Let's bring in our Bloomberg Intelligence Senior Equity Analyst, Stephen Trang, here with us on set to help us understand what signals the markets are looking for as TSMC reports their results in a few hours, Stephen.
Okay. I think the key is all about outlook. Obviously, in the near term, in Q4, I think the streets are looking at like a somewhat soft sequential decline in Q4, but then there are obviously some expectation about the potential upside surprise in Q4 revenue. But that's really the near term. I think the more about the mid to long term is about that. Like we hear a lot of the announcement made by OpenAI, for example, the alliance with a couple of the major chip makers. Pretty much everyone's are TSMC's major customers. And they were talking about like a Stargate. They have this major expansion over the next 3-5 years. So how would that translate into the revenue growth for chip maker like TSMC? That is definitely the key for investor. They definitely want to try to find out during the result call today. So that's on the revenue front. And then something related to that is CapEx.
Yeah.
The company has been guided for about 38 to 42 billion US dollars CapEx per year. That's for this year. And even though the management's earlier comments that they don't necessarily swing their CapEx significantly given their company size, but given the growth, right? So I expect some investors are also looking forward to some sort of upside surprise in terms of the CapEx guidance for next year. And then another thing is about the margin. Specifically because they are now having the increasing ramp of overseas fabs, like in Arizona, for example, that could potentially be a drag to the gross margin. The management actually made that very clear. That could be a long-term drag, actually. And in the near term, we also have the stronger Taiwan dollars, which also eat into the margin. So those are kind of negative factors. But on the positive side, we do have the strong demand from AI, and that helps the demand for the advanced process.
Which really leads me to the next question for the industry as a whole and the impact that we're seeing. There's obviously some concerns about overvaluation in some of the Mag 7 and how that's going to translate to the orders going forward. So the order book, if they open that up and look at what's actually being ordered from the U.S., ASML is one. They had an increase, they beat on their orders, obviously. Does that indicate as well, the capacity build out for 2 nanometer?
Yes, I think so. I'm seeing the positive guidance from ASML did imply that TSMC's second 2 nanometer progress may be faster than expected. So that's definitely a positive sign. And then all the AI build, obviously, there's some uncertainty there. But then from the chip making perspective, TSMC is really the ultimate chip maker of all the AI accelerator at this point. So one way or the other, I think the company will benefit from the overall AI spending.
Okay, thanks so much. We'll be watching it later today. That's Bloomberg Intelligence Senior Equity Analyst Stephen Trang. Still ahead, China's markets are showing signs of fatigue after a sharp rebound. We'll ask the head of UBS Global Research where stocks may find support. And we are counting down to the open of trade in Shanghai, Shenzhen, and here in Hong Kong, obviously, as we do every day on The China Show.
Yeah.
Because this is The China Show.
Right, welcome back. All right, breaking news right now. The renminbi, before we talk about the chart in a moment, but you can read about it, just in case you need more time to digest things. The renminbi fix of the day is another punchy one. Another one, second day in a row, it's below 710 from the PBOC. It's the second day in a row, in fact. Last time, I believe we've had 2 days in a row was, I think, this time last year. I could be mistaken. I'll correct myself as far as that's concerned. The other thing, of course, we want to point out is obviously MSCI China on your screens. We've been hovering. We did catch some support on the 50-day. We're consolidating around that level. UBS, I think about 2 days back, came out with a note and said, near-term pressure might something to be considered. But when you look at the 74 handle, that's where bargain hunters, and that's likely where the market, if it does, of course, fall even further, might actually find a lot of strong support. In fact, the author of that report is here with us on set, James Wang, Head of China Strategy at UBS Global Research. James, good morning. Nice to see you, sir.
Great. Thank you for having me.
Lay out the thesis for us, and why 74?
Yeah, so we had a long think about it, and we think, where's the kind of level that investors are likely to get into? So we think, if you think about what the conditions now versus the past, I think where we are now is quite similar to around about before China's 145% tariff got rolled back. So around just before the Geneva
early May, right?
Yeah, early May, correct. And that back then, China also had very high tariffs, but very high expectations that somehow they maybe get rolled back. And also since then, we've had a de-escalation and we've seen record trading volumes. So investors have been building up positions since then. Before then, a lot of uncertainty. And also back then, there was also clarity that we're not going to get global tariffs like we saw just before April. So I think that's the kind of level we will see buying support. I really don't think we're going to get back to the April lows when there's maximum uncertainty, universal tariffs. And while I think the 74 is the comfortable level at which I think investors will get into, we do advise investors to start dip buying. And certainly I think investors do want to dip buy on the market because I think most investors don't think the current 100% tariff is tenable. We've already had that kind of negotiations before.
So are we in a bunch of noise right now leading up to November 1st and through APEC and potentially that meeting between Xi and Trump as the two sides build up their leverage? Should investors sort of not necessarily discount that, but it's not as bad as it was in April?
That's our base case, correct. But that's not to say that there may be some profit-taking pressure because the market is up quite a lot, right? If you look at MSCI China, it's already up close to 35% from the April trough. So there may be some of those that profit take. But I think, yes, I do agree with you, Steve, that for us, I think it's going to be a lot of noise, but that might cause volatility in the market during that time.
Which sectors do you expect to see the inflows as you advocate, of course, is buying on this dip? Yeah,
so if there is volatility and if we get another drawdown, I think the sectors that have seen the least rebound. Okay. And also, if you look at during April, what are the sectors that saw the least decline? It's things like food and beverage, so some of the consumer names and some of the utility names. So that's probably a place where I'll be hiding. On the other hand, if you want to dip buy, I would say that it's sectors like the hardware tech names, the tech names or data center names that have seen probably the biggest rebound since the April trough. Now so that's how I would play it. Yeah.
You prefer A shares over 8 shares here in Hong Kong. How come?
Yeah, so we like A share even before the trade tensions escalated. And that's on the basis that we've seen retail money start to be putting to work. So the one thing we track, for example, is the number of new retail accounts that's open on the A share. It's decelerated a little bit, but it's still up quite a bit versus last year. We're talking about 50-60% year-on-year increase. And we've also seen household deposits being put to work. So that's decelerated. And on the other hand, it's moved money into non-bank financial deposits. So that's money sitting in brokerage accounts. And that trend we've just starting to see. And we think, given the very low interest rate, equities do look quite appealing to the average person in China. And so we think that trend is going to continue. Now, given the trade tensions, A-share look even more appealing because we've got the national team potential support. And also year-to-date, A-share has underperformed, particularly the CSI 300. It's underperformed versus Hong Kong. And also, if you look at the April episode, A-share has outperformed versus Hong Kong. So from all this perspective, I think A-share is probably the better place to be, particularly CSI 300. Yeah.
Okay, James will be staying with us, of course. We'll be back with him in a couple of minutes here. He just came from a trip, of course, and had a conversation with global investors. We'll dig into all of those insights in a moment here out of UBS Global Research there. Right, going into the open today, some weakness coming through. Hang Seng Index coming up on your screens. The strongest fixing out of the PBOC since, well, this time last year. 712.38 now is dollar offshore. The opening bell, 7 minutes, 30 seconds away. You're watching The China Show. Good morning. The joys of Thursday. Yeah, there we go. A day to Friday, and then that's 2 days before Monday.
Is that a saying?
Yeah.
Joys of Thursday?
Yeah,
Okay.
I'm going to start that now. That's next to the Ides of March, of course. There we go, 0.3%. The reason we're looking at gold right now, so I think there's a scramble now to update views there. So I think we had Goldman, I think it was last week. My producers are about to whisper, not sweet nothings in my ear, but there was another projection that took it to 5,200, I believe, or 5,000 yesterday. Now ANZ's coming out and saying 4,600 on gold. They've raised, the Fed is now expected to cut 4 times. 0.3% to the upside. Okay, let's go into the open today. Let's have a look at the approach, 4 minutes, 30 seconds, and we're looking at, okay, that's fine. A little bit of weakness coming through, not a lot. 8 shares are coming through. It's worth pointing out we did flirt with entering, flip the page please, a technical correction on the Hang Seng China Index. It doesn't seem like we'll be getting there today. We'll see what happens. Of course, Hang Seng Index, 26,000. There's a trading debut today, of course, which is this Beijing Yunji, I believe, is the trading debut today here.
That's right, the maker of embodied AI robots.
Oh, okay.
So it's a hot topic.
It really is. You know what surprised? Well, not. You know what's fascinating to me is that all these humanoid robots in their current form, whoever invented RoboCop in the 80s was terribly accurate because a lot of them are like, almost like twins of RoboCop, aren't they?
Yeah, the moral hazard of embodying intelligence into killing machine, right?
Law enforcement,
yes, right.
Of course, and gone wrong, I think, in many ways, depending on what part of the movie you dip into there. PCCW is very much in focus here. This was, of course, on the back of the FCC move here. Yeah,
that's right. So the FCC is basically blocking PCCW from access to U.S. networks, asking them to explain why they should not do that.
Okay, going into the open today, we'll talk more about Antisports, Pop Mart in a moment. The opening bell, 3 minutes away. This is The China Show.
And welcome back. You are, of course, watching The China Show. We are counting down to the open of the markets in about 39 seconds. Lots to digest today, Dave, because of the increasing trade friction, if you can call it that, with Donald Trump also essentially declaring that they're already in a trade war with China. We also had a fairly sharply written rebuke from state media, the People's Daily, out of Beijing. And, of course, we had that credit data, which suggests out of China that lending and borrowing, I should say more appropriately, from corporates and households is still lacking.
Yeah. I mean, I think the term aggregate financing is, I think in some ways does a disservice to really what you see underneath the hood, right? So to your point, household and corporate borrowing does remain below trend, but of course this pickup in publicly issued debt, of course, was I think what kept that decent. Okay, let's go into, and as I talk about this, can you bear with me because I have to also create a chart while I talk about this. But yes, have a look at the open here. We're looking at 4.10 to 1% to the downside. I'm really looking forward to, by the way, to the point that Steve was just making there. In about an hour's time, we'll be joined on shows by Wu Xinbo, of course, who is an advisor to China's foreign ministry. So we'll get really a better indication of really the views as we talk about what we heard from President Trump, what we heard from Scott Bessent, longer and higher tariffs, and possibly, maybe, do they roll over it again, right? 90 days. So we'll see what the view is as far as China goes. And also, of course, looking into the G7 and what that statement looks like, if we do get a statement on rare earths and, as China looks to, I guess, secure more influence over the global supply chain. Flip the page, please, and have a look at where we are as far as Hong Kong goes. Bottom of the screens will be coming up shortly. A lot of the big tech plays, Tencent, go all the way to Xiaomi, Baidu, Meituan there. But yeah, lots to watch here as far as the telcos are concerned. I mean, we talked a little bit about this, but one of the big stories, of course, was PCCW and why we're looking at that stock here.
Yeah, we do need to look at that because, of course, the United States and the FCC, essentially looking at possibly blocking PCCW and its affiliates, the big Hong Kong, the Hong Kong telco company, essentially from the U.S. markets. It's also, of course, follows what they did for China Telecom in 2021 and also China Unicom in 2022.
Let's look at this. This is going to be interesting, right? So yesterday afternoon, we were talking about this specific stock that's coming up on your screens, Limit Up, and there were a lot of rumors that the company had an agreement with, I think, Tesla for, I think it's a robotics agreement. So the company's come out at about 9 or 10 p.m. last night and said, nope, there was no deal. Shares are obviously down right now. Not all the way down. Okay, we were up 10% yesterday. We're down 4%. Okay, let's flip the page, please. And what else are we looking at here? You know what? Why don't we look at... Oh, yes, this big listing here, Steve.
Yeah, they're an embodied AI robot maker, stock code 2670, so indicating upwards right now. So that's a hot topic. There are hundreds of companies that have tapped into the funds that the Chinese government has put out there to build out embodied AI, or physical AI, as it's also called, and they are part of that as well. So we'll have to see. That could be a good proxy to see investor sentiment towards that sector, which, of course, has given no indication that it become profitable, but there's a lot of enthusiasm.
Yeah, and certainly one of the comments, in fact, I heard yesterday, Guotai Junan's chief China economist joined our colleagues at Horizons Middle East, Jomana, and one of the comments I heard there was, what's going to be interesting is how the market trades on AI. Economic metrics like GDP and all these things, while still important, don't hold as much punch anymore when you look at how the market's reacting to news. And they're looking at industrial policy, this 5-year plan that's coming up, and really how they frame technology. There might be something that the market might be paying more attention to than actual economic numbers. Yeah. That's just to say, credit growth disappointed, of course, when we got those numbers that came out yesterday. So let me just recap some of the numbers there. We were looking at aggregate financing coming in at $3 trillion. New loans coming in at about just shy of 1.5, slightly below the survey. Money supply 8.4, M2 specifically, and we were looking at some of the commentary that's come through. In fact, Bloomberg Economics has this to say about how some of those households are deleveraging here, Steve.
Yeah, that's right. I mean, overall loan demand, when we look at the numbers, the new loans of 1.3 trillion yuan was less than expected. So overall loan demand from households and corporate is still sluggish. Yeah. Right? And that's why they're saying that perhaps there needs to be more stimulus coming forward and a long-term plan to essentially stimulate some sort of demand because households are still feeling a little bit paper poor, because of the household and the property crisis. Job prospects remain fairly dim for new graduates, and corporate profits remain under pressure. So there's what Eric Zhu is saying. China's year-on-year drop in credit expansion in September reflects the fact, as I just said, that households and businesses are deleveraging.
Let's look at a reaction also from the folks at Goldman Sachs, and effectively what they're saying is, so when you look at the aggregate number slightly above the already low market expectations. So I think that's nuance number one there, mainly due to shadow bank credit extension. But to the point Steve was making, and by the way, this is very consistent with the inflation print which came out yesterday, right? So on the demand side of the things like corporate and household demand do remain still on the weaker side of things, Steve.
Because actually aggregate financing did increase. From the previous month. It did increase to 3.5 trillion yuan in September. 3.3 trillion was the estimate, I should say. So it did beat the estimate, aggregate finance. But again, it fell short from a year ago level. So it just means there's overall demand is less than a year ago.
Yeah, well, it sounds a little bit like my ex. Despite my best efforts and everything I seem to be doing, I always seem to be missing the targets, despite having very low expectations.
If it's a year ago, let it go.
Yes, there we go. What was yesterday? Anyway, no, go ahead.
All right, still with us here before we go off rails is James Wang, head of China's strategy at UBS Global Research. We've been talking in the last segment essentially about you're saying A-share demand is probably the way to go rather than H-share because the national team could potentially come in if things get sluggish, and also the basic horde of retail investors starting to open more brokerage accounts and the like. Okay, so domestically, people are maybe getting a better appetite for the local stocks. How about what you've read from the United States or how you've met with institutional investors? Are they favoring the A-share market as well?
So overall, I'd say interest in China has been exceptional. It's probably the strongest I've seen in years, even in the US, for example.
Because it was pretty low.
Yeah, it was very low. And I'd say people do recognize there's been a policy pivot around about September. And the support, while macro data is still lackluster, but the support for the equity market has been unprecedented. So that, I think, that got investors excited on the China equity market. Now, A-share, I think there's still a bit more difficulty for foreign investors because of language translations and also just the way the market moves. A lot of retail investors are in there, so it's difficult to predict the move. So I do feel foreign investors do like Hong Kong equity market a bit more, and also most investors use MSCI China as their benchmark, which does have a bigger weighting towards Hong Kong. So still a bit more reluctance to get into A-share, but interest is picking up, even towards A-share. But for the overall China equity market, definitely very strong interest. And I do think we're going to see continued inflows from some of the large institutional investors from foreign funds. Yeah.
What is the preference? How are they doing that? What's the method? So is it ETFs? Is it coming here? Is it exposure in the U.S.? Like, what's the how?
It's actually stocks in China. So it's no longer stocks in the US or Europe. It's actually investing in China. So I've seen interest in tech, internet names, and also the breadth of interest or stocks that they're interested in has widened. So they've gone into industrial names like the auto component makers. They've gone into even hardware tech names. So there's definitely a better recognition of the advancement China's been making in the semi-supply chain, the tech supply chain.
How are they being assuaged by the overall fears, though, that and the pressures and the headwinds that we've been talking about all morning? And that is low domestic demand. People are staying, mattress mentality, and again, the overall threat of decoupling with the United States. And deflation.
So I'd say that you can see the market this year, the stocks that were up, it's the tech names that has strong fundamental support. Those that are associated with the macro, like consumers in particular, they've been weak. So the market's been pretty fair. And so foreign investors have been shining away from some of these macro-related stocks. But they've been definitely getting to tech, been getting to internet names. And then in terms of deflation, I think that's where this thing called anti-involution is coming in, right? And for the first time, I think, and I was very surprised, there's been very strong interest from foreign investors on this. And I think the key reason is that China's been having tremendous GDP growth, but that has not translated into earnings growth, which is what investors care about. And that's because of too much competition. And for the first time, the government now cares about corporate profitability through anti-involution. So if we get that right, that translates into the fundamental support for the equity market.
But has anti-involution worked? Because there's still a race to the bottom. Price war in EVs, embodied AI, we were just talking about that. I talked to McKinsey and he said the big question about embodied AI or physical AI is there's all these companies throwing money at this, but it's going to be a similar situation as EVs. A race to the bottom, get market share, and to the detriment of all those others.
So there's definite doubters on this, and you see if you look at it from a different sector perspective, the effects are quite divergent, but you can see some effects. So for example, the thing I track as a strategist is PPI, and that has a direct correlation with company revenue, and we're seeing less decline in the PPI.
36 consecutive months of PPI deflation, 3 consecutive years in the data yesterday.
So it's just less, a little bit less. And that as people that look at the market, people do look at
the delta matters?
The delta.
The delta,
Okay.
And we're climbing out of a very difficult spot. But the other thing to remember on the macro side of things is a lot of that did have to do with the property down cycle. And we're in the 5th year of the property down cycle. And property prices have gone down from 40% from the peak. And so you can see value coming out of the property market, rental yields back up to 2.5%, where interest rates are quite low. So to me, I think the ingredient for a macro turnaround is still there. And maybe right now it's still very tough, but something to look forward to next year. Typical property down cycles last for between 6 to 8 years, and we're in our 5th year. Next year's 6th year.
Yeah.
You're just to end on your outlook on liquidity conditions, which have been really the crux and the funder of this rally. Where do you think that story goes?
I think there's still a long way to go. I think now that U.S. is expected to cut interest rates, that also helps EM inflows. That will help China indirectly. So we are overweight EM and we're overweight China globally because of that potential inflow. And then domestically, we're talking about deposit rates at 1%, and I expect that to go down now that U.S. interest rate is being pushed down too. So all of a sudden, you've got the equity market yielding you close to 3%. I think that is still looking like an attractive asset, particularly if it can show price appreciation. So that domestic flow into the equity market, I think that will continue. And as I said, I think foreign inflows will also continue. So both domestic and foreign inflows, I think, will support the China equity market.
James, always good having you in. Thanks so much for joining us this Thursday. James Wang, head of China strategy at UBS Global Research. Coming up on the show, Hong Kong tycoon Richard Li's phone company, PCCW, faces a ban in the U.S. over national security concerns. Details of the FCC order are next. This is Bloomberg. And welcome back. You're watching The China Show. Well, the U.S. FCC is taking steps to block the Hong Kong teleco HKT, citing national security concerns. FCC Chair Brendan Carr says the move aims to ensure the safety and integrity of America's communications network. He says the FCC will continue to safeguard networks against, in his words, penetration from foreign adversaries like China. Dave?
Yeah, let's bring in Shirley Zhao, who is helping us cover this story for us. There's a nuance here, but I mean, yeah. So why this decision, and actually why now?
Right. So the FCC basically sees HKT as an affiliate of China's state-owned telecom company, China Unicom. China Unicom holds about 18.4% of shares in HKT's parent company, PCCW. And China's state-owned telcos, including Unicom, China Telecom, and China Mobile, were already banned from accessing the U.S. market. So this is basically an extension of that ban. And why it's happening right now, it's because the U.S. and China is locked in an escalation of the trade war.
What does this mean then for them? Do they get blocked from U.S. networks? And what could be the possible remedy? Could there be a move by PCCW to divest or try and find a way to limit that stakeholding that you said? Is it China Unicom that owns the big stake?
Yes. So from the business point of view, the impact is likely to be limited because HKT and PCCW have limited exposure to the U.S. market. So basically, their HKT's business in the U.S. right now is most likely to be limited to people roaming from Hong Kong.
That's not affected?
That will be affected because if the ban is in place, that they've basically lost the U.S. access. But PCCW as a whole made about 13% of revenue from regions outside of Greater China and Singapore. And although it didn't specify what those regions are, but the U.S. is likely, have an even smaller share in that 13%. The 13% itself is not a big number. But politically, that means the Li family and, Richard Li is facing a lot of political headwinds because we know that PCCW is controlled by Richard Li, and Richard Li is the younger son of billionaire Li Ka-shing. And Li Ka-shing is right now trying to sell 43 of his ports, including 2 in the Panama, to a consortium backed by U.S. investment firm BlackRock. And that deal has angered Beijing earlier because Beijing saw it as kowtowing to U.S. pressure. And Beijing has already told state-owned companies to not collaborate with the Li family in the future, according to Bloomberg reports earlier. And Bloomberg also reported earlier that Richard Li, who's trying to expand his insurance business into mainland China, and
FWD,
that talk,
right?
Yes, and that talk had been stalled in the process. So this basically shows that, how much political pressure could be on companies based in Hong Kong during the China-U.S. trade war. Basically, they are sandwiched between China and the U.S.
Shirley, thank you so much. Shirley Zhao there with the latest on PCCW. I think the earlier point that Shirley was just making, you look at the share price today, effectively just yawning it off. And I think I'm already being quite liberal with that description. Okay, let's have a look at, one of our big take for today here. So you have a few people who may have actually heard of Radiant World, but it is one of the world's largest traders of iron ore, and the company's rapid ascent and growth has really rattled the global commodity community here and even drawn attention from China. Let's bring in our Asia metals and mining reporter, Catherine Gemmell, to help us understand the crux of today's big take. Catherine, the Radiant World seems to have, I think for many people this is a fair statement, seems to have just come out of nowhere. Give us a background. Who are they, and why is the market now paying more attention?
Yeah, hello, absolutely. So Radiant World started life in the early 2000s and it is now based out of Singapore and has grown almost tenfold in the last decade. I think what is really interesting about these guys is that they've become one of the biggest iron ore traders globally, up there with Glencore. But, really not many people outside of the iron ore world know about them. It's brought this fast and aggressive style of trading to a market that's typically slow, contracts driven, and really dominated by the big miners and the steel mills in China.
But how has it done this? Hi, this is Steve Engle here. I mean, how is it competing with the likes, as you just mentioned, Glencore, and what's really behind that meteoric rise?
Yeah, I think that this really comes down to its appetite for risk and willingness to take risks where others don't. In our investigation, when we talked to numerous market participants and insiders, they told us that they're willing to buy iron ore cargoes when it's cheap, potentially buying them for above market price to secure the supply and taking really bullish positions on this. And this has really worked in their favour because prices have stayed pretty high this year, which has resulted in record profits for them. But it also really puts them at risk because if these prices fall, then that could be where they make some losses.
Okay, we've talked about how everyone is now paying attention. Could the company actually move global prices on iron ore?
Yes, potentially it could, and I think that we can really see that because Glencore, which is a major backer, has a dedicated team that is looking over their risk in China. CMRG has also told mills to not do business with them, which we found out through our reporting. And I think that's really because if prices fall, then they may be forced to offload cargoes, which could then trigger a wider price fall across the market.
Fantastic piece there. You can check the big take out for Bloomberg clients on your terminals. The entire piece, of course, is also on the website, Bloomberg.com. The function on the terminal is NI space big take. Go. This is The China Show. We'll be back. Right, welcome back. We're looking at PopMart today, and really the story here is, well, for one, 5%. Steve and I almost didn't get ready for the show. We were comparing notes here on our favorite Labubus. So clearly that did not happen. JP Morgan, the price target here, 320 a pop, overweight there from the team, continuing this rush from the sell side to upgrade the target. So it really applies to gold. It's also been applying to this share price as well. As you can see, we're closing in on $300. 40 buys, 3 holds, 0 sells across the street here. And to sports.
And to sports in focus, they've ordered to provide compensation to because of a fireworks show in Tibet. So there's been a public backlash because of the effects on the environment. This was a fireworks show that was sponsored by its subsidiary Arc'teryx. You know, they call it the sort of the Prada of athleisure wear. Arc'teryx, very expensive stuff, right?
Okay.
Anyway, that's beside the story, beside the point. The stock is, though, up. Maybe on the fact that there is some sort of resolution to this online outcry.
Well, but my question is, do you really need the apostrophe there on the name? Because that really is a bit of a landmine when you try and pronounce it. But yes, anyway, that's, I think, a completely separate topic. UB Tech, let's have a look at that. That's coming up on your screens now. Okay. 3%. Robot contract, 32 million is the price of that deal. And very quickly, speaking of, we're looking at Xiaomi continuing to see some downside. No specific trigger for today, but it is, of course, underperforming on the benchmark itself. Zijin Gold is going the opposite way, coming up on your screens now, included, I believe, on the Stock Connect. Really, that's a gold story. That's the debasement story, if you believe that, of course, that specific theme as well. Right, we'll leave you with a look at the benchmarks about 25 minutes into the session. We'll talk about currencies on the other side of this. Oh, why not? There we go.
I think that's the kind of level we will see buying support. I really don't think we're going to get back to the April lows when there's maximum uncertainty, universal tariffs. And while I think the 74 is the comfortable level at which I think investors will get into, we do advise investors to start dip buying. And certainly I think investors do want to dip buy on the market because I think most investors don't think the current 100% tariff is tenable. We've already had that kind of negotiations before.
That's UBS Global Research's James Wang speaking to us in the last hour here on the China Show. He's saying there's a lot of noise in the market. Disregard the noise, buy the dip. Prefers A shares over 8 shares on the back of potential national team coming in and also the retail investors in China opening up more brokerage accounts and maybe also coming in to the local market. Welcome back to the China Show, Dave.
Yeah, about half an hour into the session there, we talked about this dynamic between A and H shares with James Wang, of course, but what he basically thinks to your point, right, A shares outperform from here because you do have the backstop from the national team. But separately, on his trip in the U.S., of course, the thing that came up was tech and the familiar names and the broadening out of that pool that investors are looking at now.
He said something that stuck out to me, and that is the sentiment for institutional investors that he met in the U.S. was as strong as he's seen in years towards China.
Well, to the very low base when you look at the last 5 years or so. But I get to the point that he was just, I think, underscoring is he's astounded by the shift and the suddenness of how much attention, how busy he's gotten, and I think maybe just to tell our viewers a little bit of how the sausage is made. You know, when James came in here right before the show started, that was one of the things he actually told us. He just got back from a marketing trip, and he was completely taken aback by just how how welcoming foreign investors were. Now, I don't know who James talked to, but I guess I'll take his word for it. That they were really looking to increase their exposure to the Chinese market this time around. All that is to say that a weaker dollar helps, and I think the last point we made in our interview just now with James is that liquidity conditions will persist because now also the Fed is expected to keep cutting rates. I'll get to the gold implication of that because ANZ now thinks gold is at 46 because of 4 cuts. But back to the point on the weaker dollar.
There you go.
Yeah, we're looking at quite a big dip here on the U.S. dollar. We're coming off, I think, the worst day on the dollar index in about a month's time. And then since that point in time, we had the fix and even more so weakness going into the session today. Speaking of the fix, yesterday was the first sub-10 midpoint since November of last year. incrementally more today, the strongest fixing going back to this time last year, as you can see on your screens. What that means for Asia Pacific, maybe a little bit more risk appetite, maybe more scope to add more risk to the table, coming up on your screens. And there we go, 1% now on the Asia Pacific benchmark. Nikkei's up 0.7%. We'll get into the Japan story in a moment here.
Yeah,
go ahead, Steve.
I mean, the yen also gaining again. We're seeing at 150. It was 152 a couple of days ago, so getting a little bit of strength. Still around the 150 handle, though, for the Japanese yen. Well, the return of U.S.-China trade tensions is putting Asia's stock market rally at risk as the investors brace for fresh fallout. Bloomberg senior Asia equities reporter Abhishek Vishnoi joins us from Singapore. So there's volatility, obviously, in sentiment and in money flows. Why is there a favor towards the bulls right now?
Yeah, so, when the recent tensions flared up between US and China, it looked like that the markets are sort of witnessing a technical breakdown, a change of sentiment for the short term. But it looks like, they are whipsawing in favor of bulls. Tariffs have or the comments around tariffs have once again become the top indicator to watch in terms of where the markets would go. There was a test of key support, a key trend line drawn from April lows, but now markets are once again, climbing above it, and it's largely to do with what U.S. Treasury Secretary has said, dangling the possibility of a long-term truce between U.S. and China. So both countries leaders want to start from a point of advantage, strength, or bargaining chips ahead of a possible meeting between them where they can come to a consensus. But this comment from the U.S. Treasury Secretary has sort of given bulls ammunition. This is a market where ASML's weaker outlook was greeted with gains. So it very much remains a market where bulls have the upper hand. There was some test of or some dilution of the taco trade initially, but it seems like we are firmly back into the territory where bulls have upper hand.
Yeah, Abhishek, if you don't mind, I want to build on the point you just made there, and wondering how important these upcoming TSMC earnings are. So you mentioned ASML and the guidance coming through the company. TSMC, when you look at the revenue side, they report monthly sales anyway, so the revenue side's not going to be much of a surprise. But how much do you think the market, the uptrend will depend on what TSMC says on guidance?
Yeah, TSMC is about 4 to 5 times of the size of ASML. And yesterday, I wrote a post, and based on what I was getting from a lot of investors, that it's possibly TSMC's outlook that was lifting AI-related stocks across the board, not just ASML order booking. You're right. 25% sort of growth is expected, but markets would be definitely looking into what TSMC says about capex, what TSMC says about US-China tensions, supply chain, and the AI-related spending. But there is a bit of a nuance here. So you see, ASML is a chip equipment maker. TSMC is a chip maker. Now, what has happened is, if you look at TSMC, it is trading it at a possibly like 30-40% discount to ASML, right? But there is a lot more visibility to the earnings, to them benefiting from this huge amount of AI spending that companies are promising. So there is a case building up for a rotation from chip equipment plays globally to chip makers, and Taiwan is reflecting that. David, you look at that. It's now has possibly very close valuation to India on price to book, and just amazing return on equity. So it is possibly going to continue, and hopefully it will extend that optimism to other AI related markets, especially in Asia, Korea, Taiwan, China.
Abhishek, fantastic. Abhishek Vishnoi there, of course, laying out today's taking stock and also the element on AI there. I think whenever you get a comparison to India's price to book, that I guess in many ways tells you how elevated things have actually become. But that's a different can of worms. All right, let's talk about what's coming up here on shows. Urban air mobility has been taking flights So the CFO of EHang will join us exclusively in a couple of minutes to help us discuss the next leaps toward commercial approval for pilotless flying taxis.
But first, the dollar's slide has been one of the year's biggest macro trades. We'll get the outlook for currency markets next with LGT. Much more ahead. This is the China Show, and this is Bloomberg.
Right, welcome back. We woke up this morning to a much weaker U.S. dollar. I think the Bloomberg Dollar Index fell the most in about a month. We're continuing to see the weakness, the midpoint out of the PBOC perhaps helping push the dollar down even further. Hence, we're trading at 150 now on dollar. Yet employment numbers coming through out of Oz. We'll talk about that in a moment. Gold, of course, is continuing to hit new highs, 42.33. The new call out of ANZ. I'll put the gold forecast, the Fed, and the dollar together for you. 4,600 out of ANZ, as they now expect the Fed to cut 4 times. Let's put all that together in the form of an outlook. Joining us here on set, Trang, FX and rates specialist at LGT. Good morning and very nice to see you.
Good morning. Great to see you. Thanks for having me on the show.
Why don't we start off with the most, well, literally the common denominator of all these things is the dollar.
Yeah.
What's your broad take on the dollar weakness?
Yeah, so we continue to look for dollar downside. So our forecast has about 4% lower in terms of DXY from here.
Okay.
Now, obviously, that's a slower pace than the dollar sell-off we had year to date. But we think it's premature to call the end of the weak dollar cycle. And clearly, after the dollar rebound we saw last week, this week the market has returned, as you said, to the short dollar. I think initially there was a lot of risk premium price into the yen and the euro because of the political situations. Yeah. But we think concern on fiscal policy is, a bit overdone in those areas. And looking forward, we think that once U.S. data is released, it will allow the market to refocus on, the dovish Fed narratives and, near-term Fed cuts.
So you have the dovish narrative from the Fed and also the potential of a trade war worsening beyond November 1st. How much does that factor into the weaker dollar as well, in addition to the Fed easing?
Yeah, so I think it's a very interesting dynamic. So if we place that questions into, the last year or the year before, right, when you have both a Fed easing and, trade tensions, it will be a much harder question to answer because usually you would expect, opposing effect on the dollar. But this time round, after the April reciprocal tariff, the market has clearly traded that, tariff is not uniformly positive for the dollar. And in fact, we think that if Trump reopens a tariff war, I think the market would trade it continually as a negative catalyst for the dollar because of the negative effect potentially on the U.S. economy itself. And that accelerate, the potential Fed cuts.
You talked about Japan there for a moment. Wonder if you could lay out for us your thesis on Japan. I mean, so I look at the yen, fine, it's strengthening to 150, which is a very strange sentence still in my view, because who would have known we'd be trading at 153? But do you think the market's getting this one wrong? That part of the market thinks we are headed towards Abenomics 2.0?
Well, I think that's totally wrong. We think the state of the Japan economy now just is not in the state of the cycle that you can get back to Abenomics 2.0. I mean, the structure of the economy, the structure of inflation, even the BOJ balance sheet is very different now. And if you look at the value of the yen, right, it has, in terms of the real effective exchange rate, the yen has weakened by half compared to 2012. And so I think a return of Abenomic policy is a no go for Japan's policy. In fact, we think that fiscal expansions will be moderate, and also monetary policy, the BOJ will be on track for normalization. One point I would say on fiscal policy is that I think the market need to get used to a new norm on fiscal policy for DM economies where the fiscal position is vulnerable. And that not only includes Japan, also extends to the UK, even the US and France. And what I mean by that is, the ability from the policymaker to set fiscal policy is severely constrained by market forces. And, in that environment, even though there would be incentive for you to think of, fiscal policy as bargaining chip in coalition talk, but at the end of the day, the market has the upper hand. And so fiscal expansion will be more moderate than feared.
Just a side note there. So do you then expect the curves to steepen still across DM, for example, which is something we've seen in the UK and Japan, for example?
I think that would be the trend. Obviously, it would not be a one-way direction.
Okay.
But, for duration, long term, we're neutral at this level. If anything, I think the risk, when you look at the US market, for example, the 10-year yield, we think the risk is potentially to the upside from here. And we're looking at a 4 to 5% range over the medium term. And we are obviously at the lower end of that range.
At these levels now, how bullish are you still on gold?
We're still very bullish. In the short term, I would say there is, technical signals are overbought. And if you have U.S. government reopen, potentially you may get a bit of a correction in gold as people get away from safe haven. But I think any level around 4,000 would see buying demand. Now, our 12-month forecast of 4,200 have already been breached, but we see material upside risk. And I think if you look at gold, it's a commodity where supply is very inelastic. So it's a demand-driven market. And if you look at the major buyers for gold, central bank runway, we think is continue for at least another year, if not two. And even though ETF and future positioning have increased a lot this year, when you look at gold share of global asset AUM in the context of new highs in global equities and continuing supply or notional increase from central bank government bonds, then gold share of that global asset AUM is still very, very small, at less than 1%. So there's still a lot of scope for gold upside.
Just to play devil's advocate on gold, and I've seen these forecasts coming through, right? These technicals are a bit stretched. It doesn't yield you anything, though.
Exactly.
So what do you think is the allure of gold? Why do you think, not just you, people in the market think the structural flows will continue, central banks, ETFs, and all these things, into an asset that doesn't yield you anything?
But you're absolutely right. I think at the end of the day, that would be a constraint in terms of the gold rally, in terms of the fact that it doesn't have yield. But when you look at the typical traditional portfolio in the good old days, you would say gold would be around less than 5%, right, in that state of the world. But we are now in a different state where political uncertainty is a lot higher, inflation risk, is very different from 10 years ago. And so you are seeing viable change in terms of portfolio allocations to gold, at least, I would say 5 to 10%, if not even higher, depending on your other allocations. So over time, I think it's still a very structural, change in terms of behavior. One thing I would say is that I would watch a gold equity correlation, because, we have seen days where you have gold and equities, U.S. equity falling in tandem.
Right.
And that's a bad sign, because why you want gold? You want is diversification benefit in the portfolio. If you add gold, you should see the Sharpe ratio of your portfolio increase.
Right.
But if, gold correlations with U.S. equity with risk assets starts to increase in a sustained way, we are not there yet. But if it happens, then that would be a sign that, you may need to, reevaluate your gold allocation.
Do you expect that to happen, though? And what would be the trigger to basically make you more cautious? I mean, it's several days of that continuing trend.
Well, I think it will be a case of the market length having built to an extent that it becomes very speculative. So when the sort of the traditional buyers, like the central banks, kind of step away a bit, and you've seen the market rally largely driven by ETFs and by, speculative positions. And then in that in that state of the world, and if you see gold correlations with risk asset increase, then that for me would be a potential red flag.
I just want to ask what you think about very, very short-term recent phenomenon of intervention from central banks. I think we've had, India talked about it yesterday, we've had, I think in some form, the PBOC leaning into more strength in the currency, anchoring the PBOC, the yuan a little bit more. Why do you think that's happening?
I think
generally as a theme,
Yeah, so for this year, after April, when you start to see that big dollar sell-off, you would not expect, intervention in Asia, right? At least not the way, not the kind of dollar selling intervention. You may actually expect dollar buying intervention.
Right.
But I mean, for India, Indonesia, and also Japan, they have the currencies have been hurt by various, domestic reasons, and they've been trading a lot weaker or underperformed, the rest of the FX complex, and that's why you've seen that return of intervention. But for India case, I think that's a very, very aggressive statement that we heard yesterday from the Bloomberg scoop. Also, we've seen spot and forward interventions from the RBI since late September. So they're being very aggressive, and I think usually the market tends to listen from the signal from the RBI because amongst all the countries you mentioned, India, Indonesia, Japan, India, I would say, as typically most aggressive and most willing to spend real money in terms of spot interventions, to stabilize INR.
Trang Lei, thanks so much for your time here and coming into our studio.
Thank you.
Bloomberg here. That's Trang Lei, FX and rate specialist at LGT. Well, coming up on the show, Japan's Sanae Takaichi courts a potential new coalition partner in a bid to save her chances of becoming prime minister. We're live to Tokyo next. This is Bloomberg. And welcome back to the China Show. A Japanese opposition party is considering a coalition with the ruling LDP in a move that could put leader Sanae Takaichi back on the path to becoming prime minister. It's the latest in a flurry of negotiations following the shock collapse last week of the ruling coalition. Let's cross over to Tokyo now and politics and economics reporter Sakura Murakami. What is the state of play right now? I haven't even been able to keep up the pace between what the opposition is trying to do, how the LDP is trying to shore up its support. What can we expect to happen today?
So the main, the kind of secretary generals of the opposition parties will be meeting today to see how aligned they are on policy. But the main focus today is probably the meeting between the LDP and EHang, this opposition party that is considering and eyeing up a potential coalition with the LDP. If they do agree to a coalition, that would put Sanae Takaichi back on track to potentially become the next prime minister and Japan's first female leader as well. So that's the main thing to look for. That's happening later today in about 3.5 hours.
Well, how aligned are the LDP and EHang on policy? Could there be, dare I say, hiccups in these talks?
Well, on the political spectrum of the political parties of Japan, the LDP and EHang are actually not too far apart. EHang's sort of right-leaning. They want to see, for example, stronger security, stronger economic security in Japan as well. So there's quite an alignment between EHang and LDP fundamentally. But one of the things that could be a bit of a hiccup is that EHang is very strict on funding rules and political donations from business organizations. They want to ban that altogether, whereas the LDP is very much for maintaining those kinds of donations and just kind of adding transparency to it. And that could be a point of contention between the two parties. It's sort of ironic because the political funding scandal and the funding issue, donation issue, is actually why the coalition between the LDP and Komeito fell apart in the first place. So this could be a problem again. But we'll see if they can hash out those differences over the next few days.
I know legalized gambling is a very sensitive topic in Japan, but where are the bets being placed right now on the fortunes of Sanae Takaichi?
So the EHang actually held a sort of lawmakers meeting earlier today, and there weren't many vocal voices against a coalition. So I think at the moment, Takaichi's prospects are looking good. I mean, much better than they were just about a week ago when the coalition fell apart. If EHang kind of joins a coalition with the LDP, that would give a huge boost to Takaichi's standing expanding to Takaichi's potential administration, the coalition would still be short of a majority in the lower house, but they'd still be much bigger than any sort of opposition bloc that could be formed. And it would dash the prospect of any other opposition parties kind of rallying behind an alternative candidate. So things are looking better for Takaichi, I would say.
Okay. Sakura, thank you so much. Sakura Murakami there in Japan for us. Really on that note, as we head into the Japanese lunch break, we're looking at some of these names tied, whether that's strictly or loosely, to Osaka, and we're really rallying on the back of speculation around those ties right now that we just outlined for you. The other big story, of course, is on rare earths, and are we going to get a strongly worded statement coming out of the G7? How's that going to look and influence really conversations around trade ties? On your screens, rare earth stocks on the down, really been on the up really recently. And very quickly before we wrap things up, at least in this specific segment here, auto stocks in Korea are up on, again, that other point. U.S. deal hopes, specifically, of course, with the Koreans, were up about 7% on these familiar names over in South Korea. Plenty more ahead. This is The China Show.
It's 11:29 a.m. in Tokyo. Japanese markets are going on break in about a minute, and we can see the Nikkei 225 up about 0.9%, with the broader topics up about 0.5%. You're seeing some strength in the in the Japanese yen to 150.73. It sounds funny to say strength at 150, but still, with that dollar weakness that David and I have been talking about this morning, again, that is filtering into the Japanese yen. It is strengthening. Don't regard that red as a negative. That is a strengthening of about 0.2%, as we can see there. Dave?
Yeah, let's talk about this geopolitical tussle ahead of, well, we'll try and figure out whether or not there will be a meeting confirmed. President Trump, on that note, President Trump says that the U.S. is locked in a trade war with China, and without tariffs, the country, the U.S., would be exposed, he says, as nothing.
Are we in for a sustained trade war with China?
Well, you're in one now. Look, we have 100% tariff. If we didn't have tariffs, we would be exposed as being a nothing. We would have no defense.
Now, Dave, Trump spoke after Treasury Secretary Scott Bessent floated a longer pause on high U.S. levies targeting China to resolve a conflict over critical minerals.
We are currently in a 90-day roll on the tariffs. So is it possible that we could go to a longer roll in return for a delay? Perhaps, but all that's going to be negotiated in the coming weeks.
Now, for the view from Beijing, here's a quick glance at Chinese media. An article on Xi Jinping's economic thought strikes an assertive tone on trade tensions with the United States. It frames the tariff spat as among the tough battles and protracted wars China must endure to make the economy stronger. It says China will fight to the end and quotes Xi Jinping's call for party members to, quote, enhance the sense of crisis, carry forward the spirit of struggle, and improve the ability to fight.
Just glancing at the Global Times this morning, well, the take there is that the U.S. should not be surprised by moves out of China. An editorial, they're blaming Washington for this recent escalation, pointing to this series of restrictions and tariff threats after those talks, of course, in Madrid. Now, it says the U.S. overestimated its leverage while, quote, underestimating China's capacity for counteraction and its strategic composure. Let's take you now straight to Shanghai and bring in our next guest. Wu Xinbo is the director of the Center for American Studies at Fudan University. He's also an advisor to the Chinese Foreign Ministry. Professor, thank you so much for the time. I wanted to start off with the theoretical end and outcome, and maybe we can reverse engineer and work backwards here. Do you think a meeting between the two presidents is confirmed or is set to take place in 2 weeks' time? Can we start off there and then we'll work backward?
Well, theoretically, a meeting between two leaders is still possible. and I think both sides have interest in pursuing this in-person meeting between two leaders for the first time since the second Trump administration. However, we need to work hard to improve the situation so that the meeting will be fruitful, not just a photo opportunity.
Right. So when we've been looking up at the lead up to this potential meeting, a lot of the narrative has been that each side has been trying to build up their own leverage. So then they have room to negotiate based on their perceived positions of strength. From your perspective as an academic and also an advisor to those in the foreign ministry, do you feel one side might be building or overplaying their hand too much or building too much reliance on their leverage?
That's a good question. I mean, if you look at the U.S.-China trade and economic relations, how they have evolved over the last couple of years. The U.S. side started with the unprecedented tariff war on China from the first Trump administration, and then moved to the tech war on China, especially during the Biden administration. Now, during the second Trump administration, the tariff war was relaunched again, and with more Chinese enterprises have been put on the entity list, have been sanctioned by the U.S. side. So if you follow the developments, it has been the U.S. who has been keep pushing China, building pressure on China, overplay its card on China, weaponize the interdependence between two countries. So finally, it forced China to fight back, to retaliate. So back to September 19th, when President Xi and President Trump had a phone conversation, basically, I think that conversation was quite constructive. But only 10 days later, the U.S., Commerce, the BIS, come up with a new rule, 50% rule, which actually will put thousands of more Chinese enterprises on the entity list. So there's a huge impact, not only on the Chinese enterprises, on Chinese economy, but more importantly, it raises the issue on the Chinese side whether the U.S. is serious about, forging some consensus in the forthcoming summit and step by step to improve trade relations with China, or the U.S. side, within the Trump administration, was simply divided, with some pragmatists who wanted to improve relations with China. But then you have the hawkish people, they never want to, have a normal relation with China. They want to push for strategic decoupling. They want to derail this relationship. So I think this issue has to be put in a broader context.
Professor, what gets us back on track in terms of good faith, good spirits ahead of the meeting? Do we need to see gestures from both sides, an off-ramp into the meeting? So in other words, what I'm trying to get to is specifically, do you think the Chinese are expecting the U.S. president to remove the threat of tariffs in order to prove that good faith?
Well, I think the first step is for the U.S. side to scale back the new rule, the 50% new rule, on the Chinese enterprises that the BS come up on September 29th. So, and then let's go back to the recent round of talks, the moderate talks, the agreement achieved at the talks, and also the spirit as two leaders agreed upon when they had the phone conversation on September 19th. So as for the new tariff on China, I think Trump he changes always. Sometimes he say this may happen, sometimes he hope that doesn't have to happen. So that's not already in place. But what has been announced by the U.S. side is September 29th new rule, the 50% regulation.
Yeah.
I think that is important for the U.S. to scale back.
Professor Wu, let me just play the devil's advocate a little bit here and ask your opinion on whether you feel that the Chinese government might be overplaying its hand a little bit right now. That's something that's come out of Washington, that essentially they thought they had some sort of agreement on the relaxation of the export curbs on rare earth metals and magnets. And then China now has taken a much more assertive position in between the rounds of trade talks by talking about more strict control. Granted, China's trying to gain some leverage ahead of the next round of talks, ahead of any kind of summit. But are they potentially overplaying their hand in an assertive way that could also make other nations outside of the United States more angry and disrupt supply chains? We're seeing the G7 finance ministers meeting in Washington, D.C., where they're going to be talking about their own reaction to China's actions on rare earths.
Well, 2 points. First, over whether this is overplayed or not. Well, that depends on whether China can, effectively force the U.S. to scale back. Again, it's September 29th BIS new rule. So anything that can get the U.S. to cancel this latest pressure on China will be necessary. So that's point one. Point two, regarding broader ramifications of China's recent export control policy, I think most countries know this is not particularly targeted on them. It is mainly a retaliation to the U.S. moves on China. So if these countries, they handle relations with China, especially trade and economic relations with China well, without assisting the U.S. in sanctioning China, in pursuing the export control of China, I think, they don't have to worry about this. So basically, this actually gives China more leverage in making sure other U.S. allies will not jump aboard to help the U.S. in pressuring China. I think China knows how to play the card wisely.
How about the soybean issue? Obviously, it's hit hard at the base of the voting base, if you will, in the Midwest of the United States. China has not bought a single crop order from this current crop for a month and a half into that. Is that an area where you feel, because China does need to import crops of soybean, that is an area of leverage that China could perhaps be amenable to buying or pledging to buy? Or has China already pretty much shifted all of its orders this season to Argentina, to Brazil? And how important of leverage is this?
I think the soybean issue is also part of China's leverage in dealing with Donald Trump's new tariff on China. So if two sides during the next trade talks can agree to address the tariff issue, then it is possible China may reconsider to purchase more U.S. agricultural products. So again, this is, it is important to the U.S., we understand, but, the tariff is also important to China. So we have to address each other's legitimate concern so that we can have a win-win situation. So that is an issue that can be negotiable.
Okay. The U.S. Secretary Scott Bessent mentioned that we're effectively operating on sort of the rolling over of these 90-day truces, these extensions, if you will. And we're obviously, markets, businessmen, investors, newsrooms around the world are fixated now in this last week of October, when that is when the next, of course, meeting and hopefully the last deadline is going to be taking place. But in your view, Professor, do you think we still should consider another extension of these talks beyond October?
Well, I think the another extension is the minimum. But what I expect is something more than that. I mean, if two leaders meet, they should not just agree, let's, extend this for another 90 days. They should make the decision, to solve the tariff issue. Whether this is going to be totally removed, as the Chinese side suggests, because this is a unilateral tariff, illegal, or it will be 10% or 15%, then that will be reciprocal. I think the two leaders, if they meet, first and foremost, they should make decision on the tariff issue rather than leaving this to future for another 90 days or 100 days, because the business community in both countries and broadly, they don't like uncertainty. They want a clear message from both sides. And also, I believe at this stage, China and the U.S. should be ready and prepared to put an end to the tariff issue. To some extent, the U.S. side, Donald Trump himself, should now understand the limit of his tariff cut on China. He has overplayed it, and it has been counterproductive. It has been hurting both sides, and the U.S. side even more so. If you look at the inflation rate coming back in the U.S., so it's time to put an end to the tariff cut. Of course, China and the U.S. will continue to struggle on other fronts, but tariff, to some extent, is an cut that should be discarded, in my opinion.
Professor, we've heard consistently and constantly from the Chinese side the request for respect, to be treated on equal grounds. We've heard consistently as well from the Chinese side that China does not want to get into this, but will fight, of course, if pushed. Do you think if they don't agree to terms, is China prepared to walk away from the table, you think?
I think China, we try to work for a good situation, a win-win outcome, but we have to prepare for a worst-case scenario. I think that has been the case since the beginning of the second Trump administration. If you look back, the earlier crossfire between two sides over tariff issue. So China didn't beg for negotiation. And every time when we sit down for negotiation, if no agreement could be achieved, we can walk away without any agreement. So that's something we can accept. We don't beg for negotiation. We don't beg for talk. We don't beg for achievements. But if you have the willing to strike a deal, we are prepared.
Professor Wu, thanks so much. Wu Xinbo, Director of the Center for American Studies at Fudan University in Shanghai. Thanks so much for joining us here on The China Show. Coming up, EHang completes its first regulatory trial flight in Thailand. We'll talk exclusively with their CFO next about when we may be catching pilotless aerial taxis, eVTOLs they're known as. This is Bloomberg. And welcome back to The China Show. Well, Chinese flying taxi maker EHang has been conducting test flights in Thailand in collaboration with local authorities and partners. The tests involve its pilotless electric vertical takeoff and landing vehicle. That's a mouthful. Better call it eVTOLs, taking place in a so-called sandbox zone near Bangkok. EHang hopes the process will help fast-track commercial operations in the Southeast Asian nation. Joining us exclusively now from Bangkok is EHang's CFO, Conor Yang. Conor, good to see you again. So it's an exciting area, obviously, in the low-altitude economy, for sure. Where are we on the regulatory process where you can get this commercially approved and viable outside of China and not just in a sandbox?
Oh, yeah, it's very exciting that we have launched our first commercial trial flight using sandbox approach globally in Thailand here. And, Thailand is an ideal place for using eVTOL for advanced air mobility. With 35 million overseas travelers a year and densely populated urban area and persistent traffic congestion, that eVTOL can really solve the traffic problem here. So we're very excited about the initiatives. And yesterday's event was also attended by the Director General of Civil Aviation Authority in Thailand, as well as the senior officer of Ministry of Transport here. So we got a strong support from Thailand's government. That their target is to have this eVTOL commercial operation happen using a sandbox approach in like 3 months' time. If that happened, Director General's goal is to have Thailand become the first countries using sandbox approach for commercial operation globally. And we're really excited about this. And so after the trial flight, if we accumulate enough safe data, which we believe we will, and we should be able to receive the permit for commercial operation in the confined area, so-called sandbox approach. And we'll expand that into many other locations, such as Phuket Island, such as Koh Samui, Koh Tao, and Pattaya, and many other places. So we meant to build Thailand as a regulatory and operational blueprint for our global expansion. Yeah, countries such as, other than Thailand, countries such as Vietnam, Cambodia, Malaysia, Indonesia, Singapore, those surrounding countries in Southeast Asia, they're also watching Thailand's move. If this happen using sandbox approach, that means global expansion will be quickly expanded into other part of the world.
Conor, you mentioned 3 months. Correct me if I'm wrong. Is the timetable after 3 months is when you want to start commercial operations in the sandbox? Could you be more specific on the timeline when you hope and aspire to have commercial operations in many of those other cities and places in Thailand?
Yeah, that's the goal that in the press release that the Director General of Civil Aviation Authority of Thailand, they want to make it happen. And as I said, that Thailand is a very, very important, strategically important for the eVTOL global expansion, and use that as a blueprint to expand not only Southeast Asia, but we also have seen that the country, the Middle East, like Saudi Arabia, UAE, Qatar, they are also extremely interested in deploying eVTOL for like an advanced air mobility. Yeah. So after this, hopefully that by the first half of next year, you will be, when you visit Thailand, many places, you will be able to purchase tickets to save your traffic time, and also that could be used for aerial sightseeing as well.
What are your biggest challenges there outside of China? I know in China the low altitude airspace is largely controlled by the military, so there's lots of regulatory hoops you have to jump through and to get beyond the sandbox and into commercialization in the various municipalities. In some place like Thailand, did you pick Thailand because you find that the regulatory environment is maybe even a little bit more relaxed? I don't mean to put you in a position where you're trying to get ahead of the regulators, because you're at the mercy of air traffic regulation and government regulations. But did you find it more amenable to this kind of innovation? If you're on a 3-month timeline, it seems pretty fast.
Well, the Thai government is very proactive, in terms of making this happen. The global advanced air mobility, globally, there are many countries interested in developing this eVTOL as a new traffic new vehicle for transportation to solve the traffic jam problem. And of course, that is a new industry, and globally haven't have any country starting commercial operation yet. There are definitely there's hurdle need to go through, but we believe, in the long term that air taxi will happen. People can use eVTOL to solve many traffic problems, and we hope that we continuous effort to communicating with authority globally in many countries, especially Thailand. So hopefully that we will make it happen together with help from the authority in Thailand.
Conor, in about 30 seconds or so, if you could, because we're almost out of time, what's the next market after Thailand?
Yeah, here that Middle East, we have seen strong interest from Saudi Arabia, UAE, Qatar, and also countries such as in here, Vietnam, Cambodia, Malaysia, Indonesia. These could be the potential country for next step once the Thailand start the commercial operation using the sandbox approach.
Fantastic. Conor, thank you so much. Great to hear the updates out of the company. Conor Yang, the CFO of EHang in Bangkok for us, with that announcement on their sandbox, of course, in Thailand as a jumping off point for other markets, including his last point there, some places in the Middle East. Billy, barely up. The call this morning on Huatai now taking the price target at the very high end of the street range here, 316 a pop. There's the price target out of Huatai, 8 shares for Billy. We're wrapping things up just with a look at Hang Seng Index as we go into the last hour trade. And
down.
Uneventful day so far.
Yeah, not like yesterday. Today's good.
Quite a bit of a low,
low bar,
which is a good thing because it's been a manic news year so far. We'll see you all tomorrow.